Hi, this is Efrem Hoffman broadcasting from NakedSwanTrading.com on May the 9th, 2012. It's currently 1:50 p.m. This video was intended to go out today as we are now approaching some very critical risk windows across a number of securities in the Dow Jones 30 Index. There will be other videos available on our website at NakedSwanTrading.com that will also highlight the following equities. It's going to be highlighting Disney. It's going to be highlighting General Electric, highlighting Minnesota Mining, highlighting Nordstrom, highlighting Macy's, the XLY Discretionary Index, as well as Ingersoll Rand, and as well as the Home Builders Index. We will also include an analysis and a video alert on the VXX, which is basically the ETF that is linked to the volatility index, the VIX. So going back to this specific risk map that you're seeing on the screen, it's specifically a high definition risk map that's exclusive to NakedSwanTrading.com. It was developed over a 16-year period, and basically what you see over here is basically a confluence of boundaries that extend beyond the current price, because the current price is over here. You can see the last print was 74.68, down about 72 cents, or 0.95% today so far. That's just the short picture, but if you take a look at the big picture scenario, it's quite a bit more intense, and you'll see in a second over here. Bear with me while the screen is kind of moving up and down, just because there's a bit of a fast market going on. So what those boundaries represent in the future is basically the inflection points of zero momentum boundaries that traders on different time horizons will actually see only in hindsight in the future. So we're actually getting a sneak peek at what levels zero momentum crossing points would take place across a 360-degree view of different time horizons, going from short-term cycles or short-term traders that are very fast to very, very long-term traders. So pretty much, we could see all the way out, at least for this analysis, into May of 2013. And what the broad picture shows here is that investors that have recently, participated in some nice gains, especially since that low in March 2009, or new traders that have come in recently off of that little low in April, you should be aware of, very high risk in the short term, intermediate term, and long term. So this is a very dangerous area to either add to positions or to stay in positions. And for aggressive traders, of course, this is definitely, one of the equities that, you may want to look at, shorting opportunities. This is not a recommendation to go short or of any kind. This is instructional information to indicate key areas where that if you do have a trading system that you like following, it's likely to to have enhanced signals when you get into these specific time zones and price ranges. Now, let me define what I mean by those price zones. But before I could do that, I think it's important to understand that these lines that you're seeing on the screen don't only represent overhead resistance or support areas, and they don't only represent areas where there could be changes in sentiment in what investors on different time scales are going to be seeing. So in general, when you see an upward sloping line, whether it's on an upper line or a lower line, any upward sloping line is going to behave as a bearish view for that specific time horizon. So if a line is sloping up, it's going to be bearish. If a line is sloping down, it's going to be bullish. Now the trick is there a mathematical structure that exists that defines the relationship between the sentiment across all investor time horizons so that we don't have ambiguous signals like many systems do when they look at a short-term 5-minute chart and then a 30-minute chart says something else and a daily chart says something else, and you get all confused. And with confusion, it breeds the inability to actually execute and act on a decision and make a decision. And trading is all about making decisions in the face of uncertainty. And the whole purpose of this risk map is to reduce the level of uncertainty by actually having a framework that integrates, or creates a confluence of different events and different time horizons, and then makes sense of what the logical path will be without having to worry about whether a short-term time horizon indicates something different than a long-term time horizon. The reality is the markets are tightly interlinked. They're holistic creatures, which basically means that you're never going to have a situation where all time horizons are going to give you the same information. Otherwise, the market would be dead. You basically need to eye in on the dominant trend that's upcoming, that's about to shift, before it shifts, so that you could be aware of it and then drill down to smaller time horizons that lead up to the longer time horizon that indicate how information, whether it's on the sell side or buy side, is going to propagate through the social network that is the marketplace, and it's one of the largest social networks. It came before social networking. So the key thing is, I'm in this risk map, I'm modeling the financial markets, or looking at it from the framework of a social network and how information gets transferred from one time horizon to another and from one trader group to another. And secondly, I'm trying to define situations that when there is a shift in trend that is anticipated, that it's going to be highly resilient to new incoming information, whether it's fundamental information or just random noise due to just short-term high-frequency traders moving from one level to another. And if you could be aware of that resilience to information, then it's more likely that when the trend starts, it will start to escalate from level to level. So on this specific risk map over here, what I've laid out is the areas where you should be looking for intense resistance. Now, right over here, we have a situation where basically this level over here, the level of 77.51 to 78.91, if there was an amazing news report and for whatever reason, for the remainder of this summer, let's imagine that price spiked into 79.30 to 80.27. That is a perfect area, to really look to consider short opportunities. But again, this is not a recommendation. It's somebody who does that for a living would likely have enhanced signals around that area if they already have a signal there. But in general, that is extreme overhead resistance, okay, for that period. We also have right now, extreme resistance along this blue line that you see over here. It starts off basically today, it starts off at a level of about 77.08 and then goes to an extreme of about 79.43. That's not an indication that prices are going to go up to that level. If prices were to touch any point on this blue line while it's sloped up, you're going to see the market being repelled. You could see there's a whole bunch of boundaries here from longer-term time horizons that are sloped up in here, which basically means that anytime the market rallies into any one of these slope boundaries, the market is going to be repelled. Now, what the lower boundaries tell us is that when they start curling up, as I said before, anything sloping up is bearish. So when they start curling up, they won't be acting as support anymore. You can see this morning prices came down and bounced off, started bouncing off of some of these boundaries that are, starting to slope down for a period. But as prices, if prices remain consolidated in this area, and that area being, 71.50 to the lows of today, then basically any time after June 26, especially on a close below 71.34, yeah, you're going to have downside risk to 66.63, okay, going into the fall period. And then the real trouble is that we're getting into a few more risk windows over here, which basically means that if price was to get underneath 66.63, around the end of October period, and stay down there for at least one day, you could get a very sharp gap down, going into early next year, or basically into the 59.40 area. Okay, and the point is that the longest it would take for the market to really get ugly, would be, I would say, going into May of next year, extremely dangerous period for volatility. But that doesn't mean that in the meantime, there's going to be very heavy selling along these zones over here. Very heavy selling if we get on the other side of these zones over here. In between here, there's a lot of boundaries that are sloped down. So, basically the idea is take some profit here, sell over here. Take some profit here, sell over here. And then finally break underneath here, then take some profit along here, which starts out at a level of 68.50 and goes down to 66.63. Then gets underneath here, then this is the area that you got to worry about, which is 57.05. Now, in the process of it breaking down here, it's going to be contained. Okay, market will be contained, below 71.59 for the remainder going into next year once that is taken out. And we'll have, as we get into that zone, we're going to have like intraday updates, available to subscribers. So basically, we could zoom into a very short-term time interval and really tighten up those stops to keep us, in as much profit as possible as the market progresses down to those levels. Now, a really dangerous situation emerges at the end of this year going into May of next year is if we get underneath at 57.05. Stay underneath there for just one day or more, doesn't matter, and then you could really, this market could literally fall out of bed. And then by that time, the Dow, say goodbye, to the Dow bull market. I mean, it will be a secular bear quite certainly at that point. Now, this is obviously, an informational piece. This is not an investment recommendation. So I advise everyone to, either, seek a personal advisor or use your own discretion. And but I would advise you to follow these points and see how this plays out, because we do anticipate that this will play out rather vigorously based on these scenarios. Another scenario is this. Let's imagine now that, okay, the market is basically confined to this lower level, like support at 71.34, into this area. But let's imagine that we don't get underneath here for more than a day, and now the market decides to rally back up. Well, it's likely to find an intense amount of resistance starting around July the 12th at 76.71, to around 77.52, and then it's got extreme longer-term resistance bounding it at about 79.03. So it's a very, very tight window there. And the danger is, as soon as you get into that October 17th area, if price even touches it or goes above it and then turns around and flips below 78, let's say 77.96 to 78.02 for more than one day, Okay, and let's say after October 19th or October 30th, and anytime after that period, and this is kind of an ominous date because that was the 1987 crash. I'm not indicating that it has to be that date because that window exists, you know, going into January 14th, which basically means that the window represents the start date of when acceleration begins, not the end date. So, you know, breaking below that level, you're going to have a sustained down move well into next year. And then, of course, breaking below the 57.05, you're talking violent capitulation and panic selling. So not that there's not going to be panic selling, you know, between these high levels and these levels, but it's just on a smaller term time horizon. So depending on the perspective of the trader or investor, from their viewing lens, they may not think this is a significant movement. For longer term traders, yeah, they would think it's a significant movement going from the mid-70s down to 57, and certainly breaking 57, all bets off. I don't care if you're a multi-generational trader, you are losing some serious money, you know, next year, going into next year under those critical conditions. So I thank you very much for listening to this update on Boeing, symbol BA, and we will continue giving some interim updates along the way. But to get exclusive updates in real time as they're happening on shorter term horizons and on various equities and different kind of commodity markets, then stay tuned to NakedSwanTrading.com and follow us on Twitter at NakedSwanTrader or the Risk Box. Thank you very much.